You are sitting there watching the Dow hit 50,000 thinking everything is completely fine while your purchasing power is evaporating right in front of your eyes. Let us talk about a massive economic earthquake that just hit Washington because the Senate officially confirmed Kevin Warsh as the new Federal Reserve Chairman in a 54-45 vote. This is not just some boring game of political musical chairs in Washington, D.C. This is a total regime change for the global financial system. At the exact same moment this news dropped, the 30-year Treasury bond yield aggressively blasted straight through 5% for the first time since 2007. Think about that number for a second, because it means the bond market is screaming at you that higher for longer interest rates are here to stay, no matter what the stock market wants to believe. I remember sitting at my desk back in 2008, drinking a 99-cent corner store coffee, watching my account turn bright green during a temporary relief rally while the world was falling apart. The lesson I learned then that still applies today is that the crowd is always motivated by short-term blindness instead of long-term reality. Right now, everyone is chasing the massive spending mania in tech and semiconductor stocks like AMD and Cisco, while ignoring the massive structural inflation baking into the cake. Let us break down the numbers, because if you put $10,000 into an index fund like VOO or VTI today, thinking rates are dropping back to zero, you are going to get absolutely crushed. If you think the Fed can just flick a magic switch and bring inflation down to 2% overnight, you are living in a complete fantasy world. We are looking at serious structural inflation that could easily push the consumer price index into double digits by the end of this year. The escalating military conflict involving Iran is creating massive bottlenecks for petroleum refining byproducts that run our modern industrial economy. We are talking about severe looming shortages of high-end synthetic lubricants required for commercial gas turbines and military jet engines that you cannot just source anywhere else. The entire global supply chain optimized around the lowest-cost energy producers in the Persian Gulf, and that fragile system is now officially disrupted. To fix this inside the United States would require massive capital investments to expand domestic refining capacity and halt light crude exports, which takes years, not days. New chair Kevin Warsh is a strict supply-sider who openly views quantitative easing as a reverse Robin Hood mechanism that engineered a massive wealth gap. For the past 15 years, the Bernanke Yellen and Powell Fed systematically dumped trillions of dollars of artificial liquidity directly into Wall Street. When the Fed buys a security from a commercial bank, it instantly creates a brand new deposit, which explains why U.S. bank assets grew at a stunning 8% last quarter alone. That is an annualized double-digit growth rate for bank assets, which forces up asset prices and fuels insane speculative bubbles, like the current artificial intelligence build-out. Because the banks literally have nothing better to do with their massive cash piles, they pump it into private credit and tech stocks instead of the real economy. The old regime was entirely driven by macroeconomic fear, meaning every single time the stock market experienced a tiny hiccup, the Fed ran in to print more money. During the 2020 health crisis, they went absolutely nuclear by purchasing $7 trillion worth of securities to bail out the U.S. Treasury. The major beneficiaries of that massive monetary expansion were wealthy asset holders, while regular consumers got left completely behind to deal with the destruction of their purchasing power. If you own assets, you probably do not mind the inflation because your house value doubles, but the bottom half of the population is trapped in a brutal K-shaped economy. Think about the hardworking people who do not own individual stocks or real estate assets, who go to work every single morning and watch their paycheck buy less food and fuel. I recently sold my own real estate property in New York and managed to double my money in less than 5 years, which is complete proof that inflation is running rampant. In highly constrained real estate markets, where blue state regulations prevent new home construction, buyers are forced to bid up existing assets just to find a place to live. The entire housing and mortgage sector tooled up massively during the cheap money era by increasing their corporate staff by 50%, and now they are panicking. Non-bank lenders were all betting on a rapid return to 5% home mortgages, but that specific financial outcome is officially dead. Look at United Wholesale Mortgage, which is currently fighting a brutal bidding war against CrossCountry Mortgage to acquire a real estate investment trust called Two Harbors. United Wholesale is trading below $4 a share because they aggressively paid way too much for loans in the secondary market and are running out of cash. When mortgage volumes drop off a cliff, you are forced to downsize your corporate infrastructure in a brutal fashion just to survive the winter. We are transitioning into a brand new economic reality where home mortgages are going to stay locked in the 6% and 7% range for a decade. If you think a national debt closing in on $40 trillion is just an abstract number that will never affect your life, you need a serious wake-up call. The long end of the Treasury curve is moving up across the board, with the 10-year note hovering around 4.5% and heading straight towards 6%. As inflation expectations rise, money naturally flees cash and piles into equities because stocks are a natural historic reflection of inflation. But half of the modern stock market is completely passive, meaning automated ETFs automatically pull mega-cap tech stocks higher and higher regardless of fundamental value. This creates a powerful reflexive loop where stock prices scream upward on zero profitability until the liquidity rug gets pulled and everything drops by 30%. That is exactly why smart money is quietly rotating out of overvalued tech assets and piling heavily into physical commodities, like silver. Silver is experiencing a massive structural surge right now because the Chinese were massive buyers of physical metal during the first quarter of this year. This is not a traditional monetary story. Like gold, this is a strict technology and industrial supply chain story. The rapid development of solid-state batteries requires significantly more physical silver content than your standard lithium automobile battery. At the exact same time, global mining output for silver is declining because it is primarily a derivative byproduct of mining other industrial metals. When industrial demand outpaces physical availability while the AI infrastructure spend screams higher, silver becomes the ultimate technology trade. Do not expect Kevin Warsh to walk into his first Federal Reserve meeting in June and immediately raise the benchmark interest rate to fight this. If his very first move as chair was a formal rate hike, the political reaction from the White House would be absolutely cataclysmic. Instead, he is going to utilize a structural trade-off by aggressively reducing the size of the Fed balance sheet to drain excess bank reserves. Draining reserves is a mechanical form of monetary tightening that will slow down bank deposit growth without touching the front-end interest rates. He wants to force commercial banks to hold real U.S. treasuries and utilize the discount window for liquidity, rather than relying on central bank handouts. The economist profession is going to be completely apoplectic because most academic model builders do not even understand how the balance sheet works. They sit in their isolated offices building theoretical models and commenting on each other while completely ignoring how money moves in the real world. The Federal Reserve balance sheet grows proportionally with the massive accumulation of federal debt, meaning the Fed is merely the tail while the U.S. Treasury is the dog. When the Treasury Department is forced to raise $800 billion every couple of months, it dictates exactly what happens to global liquidity. You need to stop listening to the mainstream financial media telling you that a soft landing is completely guaranteed and that inflation is fully under control. Take a hard look at your own personal balance sheet right now and ask yourself if you are actually prepared for a decade of high structural costs. If you are still holding cash expecting prices to magically drop down to 2019 levels, you are actively choosing to let inflation melt your wealth. Get your capital allocation strategy aligned with hard assets and core index funds that can actually outpace the destruction of the fiat dollar. Drop a comment right now and let me know if your portfolio is actually positioned for 5% bond yields, or if you are still holding the bag on overvalued tech. Hit that subscribe button right now because we are going to keep tracking this macro madness every single week with zero fluff and absolute data. Let us get completely real about what happens to an average personal brokerage account when macro variables shift by just a few percentage points over time. If you are blindly putting $500 every single month into VOO or VTI because some internet guru told you it is a guaranteed retirement machine, you need to look at the mathematics of a higher inflation regime. Historically, the S&P 500 delivers about 10% nominal returns over long horizons, but when structural inflation sits at 5% instead of 2%, your real purchasing power growth drops from 8% to 5%. That minor 3% structural drag completely decimates the final value of your portfolio over a 30-year compounding window. If you compound $100,000 at an 8% real return for 30 years, you end up with over $1,006,000 of real purchasing power. But if you compound that exact same $100,000 at a 5% real return because of sticky inflation, your final wealth drops to just $432,194. You literally lose over $500,000 of real wealth. Not because you picked the wrong index fund, but because you failed to protect your capital from the hidden tax of structural inflation. That is why the big institutional players on Wall Street do not just buy and hold equity indexes when the 30-year bond yield scales past 5%. They understand that fixed income assets yielding 5% risk-free create a massive structural headwind for equity valuations across the entire stock market. When major pension funds and sovereign wealth funds can lock in a guaranteed 5% return on U.S. government paper, they instantly pull money out of risky growth stocks trading at 30 times earnings. This is exactly why you see a massive quiet rotation happening out of premium financial services firms and solid blue-chip companies that actually generate real cash. Everyone is completely hypnotized by the massive capital expenditure budgets of companies building out physical infrastructure for artificial intelligence. They do not care if these models are making a single dollar of profit today because they are chasing the absolute momentum of the massive monetary spend. But half of the modern equity landscape is completely passive, meaning when a few mega-cap tech stocks go up, the automated index funds are mechanically forced to buy more of them. This structural mechanism builds a massive reflexive loop that drives asset prices straight into the stratosphere on zero fundamental justification until the liquidity tide turns. And when Kevin Warsh starts aggressively shrinking the central bank balance sheet, that massive passive liquidity elevator is going to stop dead in its tracks. Think about the real-world friction of trying to purchase a home when the average 30-year fixed mortgage rate hovers around 7.5%. For a standard $400,000 home loan, a 3% mortgage rate means a monthly principal and interest payment of roughly $1,686. But at a 7.5% mortgage rate, that exact same $400,000 loan forces your monthly payment straight up to $2,796. That is an extra $1,110 every single month flowing straight into the bank instead of building equity or funding your personal investment account. Over the life of a 30-year loan, you are paying an additional $399,000 in pure interest costs, just because the era of cheap central bank liquidity died. This massive structural shift completely freezes consumer mobility because nobody wants to sell their current home with a 3% mortgage just to buy a new one at 7%. The entire housing market turns into a stagnant battleground where first-time buyers are completely priced out while existing homeowners are trapped in their properties. Meanwhile, the non-bank mortgage originators who built massive corporate empires on cheap credit are running out of operational runway. They are burning through their precious cash reserves trying to purchase mortgage servicing rights just to keep their corporate machinery functioning for another quarter. But when loan volumes completely crater because nobody is refinancing their home at these elevated rates, these companies are forced into brutal restructuring. This is not an abstract financial theory. This is a major structural consolidation that will wipe out weak financial players over the next 18 months. You cannot navigate this environment using a standard 2019 investment playbook that relied on endless quantitative easing and zero interest rates. The smart capital is actively adjusting to a world where tangible commodities and industrial inputs hold real strategic value over speculative digital promises. Look at how physical silver is decoupling from the broader monetary gold trade because of deep industrial bottlenecks. The global push for solid-state battery technology and next-generation electronics is consumption-heavy when it comes to industrial silver reserves. When global mining production is naturally constrained because silver is primarily recovered as a secondary byproduct, you get a classic supply-demand mismatch. This is exactly why physical commodities are staging a major long-term comeback against pure digital asset plays. The big players are quietly accumulating hard assets because they know you cannot print a physical ounce of silver or a barrel of high-end synthetic lubricant. They are positioning their capital to survive a prolonged structural conflict where real-world scarcity dictates global asset pricing. Stop letting the mainstream financial media lull you into a false sense of security with their endless predictions of imminent rate cuts. Take absolute control of your capital allocation by focusing heavily on real returns net of structural inflation and high borrowing costs. Verify every single position in your personal brokerage account today and ensure you are not holding overvalued companies with zero pricing power. The economic landscape has officially changed, and those who refuse to adapt to the 5% bond reality will watch their wealth dissolve over the decade.